that don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hey guys, welcome to the Real Estate Jam podcast. I'm JD with my wonderful co-host, Melissa.
Hey, Melissa. Hey, JD.
Melissa.
How are you?
How are you? I'm good. How are you?
I'm sad because I miss you and I'm out of the office and I feel it's totally out of whack.
It's a rough life, but I'm glad you were able to make it today. Awesome. Well, we got a pretty awesome show today. We got Kent Ritter. He's the host of Ritter on Real Estate. He's also the CEO of the Hudson Investing Firm. They buy a bunch of apartments out in the Midwest, fix them up, add value, make tons of money, and it's all super easy. He does it from his pajamas in his home office. And no, I'm just kidding. Obviously,
can't see my lower half.
Yeah, that's right. He had pajama pants on before he sat down. It was really awkward. Kent, man, thanks for joining us today. How are you?
I'm doing great, guys. Thanks for having me on the show.
Awesome. Yeah,
we're thrilled.
Yeah, we are super excited to hopefully share some of your knowledge with our listeners and get going. But in order for them to be able to pay attention and not just shut the podcast off, I'm hoping you could maybe give us a breakdown of where you come from, what you're doing, and maybe why these guys should listen to your expert insights.
Yeah, sure. So I started my career as a management consultant, and I did that for 12 years. And I bring that up because as a management consultant, really what I did was I helped businesses solve problems that they couldn't solve themselves, and flew all over the country doing it. I've worked in 48 out of the 50 states. And, that was a great experience because really what that taught me was what works in business and what doesn't work in business, right? More of what doesn't work and more like lessons to learn from. But yeah, I really started to see common themes. I really gained a solid understanding of what it takes to run a business, to manage people, to manage projects, to influence people and get them moving in the right direction. And those are all things that are just critical if you want to be a real estate investor. So, I think that was a really solid foundation. Then a few years into that career, I set out and started my own consulting firm with several partners. And we ran that from 2010 to 2015. We sold it in 2015. And that really started my real estate investing career. I did a little bit in 15 as I was we were going through the sell process. I was getting interested, trying to say, okay, what's my next adventure? And then really in 16, ramped it up, started on the debt side, building a note portfolio. So selling houses on contract and holding the notes. That was all well and good, but I learned two things, at least in my experience, is they say it's good to be the bank because, you don't have as much responsibility, but I found it was just as hard to collect on those interest payments as it was to collect on rent. So I felt like I was collecting on rent anyway. I might as well own the thing. Sure. And then about a year into it, I built up a decent portfolio and somebody sold one of the houses, and I got the HUD statement because I was, holding the loan. And I'm like, wow, this guy just doubled his money in a year. And all I'm doing is getting my loan paid back. And that's great. Capital preservation is good and all. Sure. But man, I was like, I need to start buying assets. And so started with some buddies buying singles and duplexes, really kind of gross stuff. I mean, we were paying like $10,000 to $40,000 a house. Literally one of them, we just had to throw a big dumpster out front and go in with hazmat. I didn't do this, by the way, but other people went in with hazmat suits and scraped all the grossness out of the house because there were squatters in there and everything. And so, but look, you know what? We doubled the value. We bought the house for $12,000. We doubled the value of the house just by cleaning it.
Sure.
So anyway, we started out doing that, and we started, and we basically would either flip them or we would turn them into rentals. And that was good, but it just wasn't scalable enough for what I was wanting. At the same time, I had started to invest passively in other people's larger multifamily deals.
Sure.
So investing with sponsors that were doing big deals, a few hundred units, and being a piece of that property. Right. And I really got intrigued with multifamily, really dug in, started learning all I could with great podcasts like this and all the books I could read and seminars and going to like 10, 12 conferences a year and just really digging in. So I did that and continued with the fix and flips and things along the way. Did that from about 16 to 19. And then 2019, I felt like I knew what I was doing and felt like I had all the mentorship I needed and the guidance, and went out and acquired with a couple of partners 250 units down in Atlanta. And that was our first big project. That was our first syndication, where syndication meaning basically what a syndication is essentially you're just raising private money for the equity of the property. We're still going out and getting a loan for 75, 80% of it. But for the other 25%, we're bringing in private investors, typically in the range of like 50 to 100,000 a piece, to raise that equity. And then they are owners, in that property right alongside me and my partners. And so, and that's really the model that we do today. But the first one was in 2019. We had a milestone last June. We sold that property and returned about a 25% IRR. So like a year over year return back to our investors. So it was a home run. We expected to hold it for 5 years, but the market was so hot, we sold it in 21 months.
Got out while the getting was good.
Yeah. I mean, we promised, well, you never promise, but we thought we would have a 15% return. Sure. And 25% return was a hell of a lot better. So we decided to take that and run and move on to the next property. So fast forward, really rinsing and repeating through the next couple of years. And now I'm working on deal 9 and 10 right now on the syndication process. And it's really just, like you said, it's value adds. We're finding properties where there's some sort of deficiency that we know we can come in and solve, whether it's mismanagement, whether it's undercapitalized, meaning they just don't have the money to keep up with all the capital expenses, but they're just undervalued. And so we can come in and we can infuse capital, we can better manage them professionally, and create a lot of upside, increase the income and increase the value of the property.
Okay. Well, that's a ton to unpack. I think what I'm most interested in, and I hope that the show listeners are interested in too, really comes down to in the commercial real estate space, when you're looking at running these syndications, you guys aren't going direct to seller, right? You're partnering up with other brokers and doing it that way. Is that correct in your guys' case?
We'll do both. So most of the deals that we do are through brokers. So, working with full marketed deals or deals that the brokers haven't quite fully marketed yet, but they have a listing on.
Sure.
But one of our syndications was direct to seller, and it was through a mailer.
Wow.
So we bought a 29 unit apartment with a mailer.
That's great. That's okay. That is awesome.
I'm sorry. Let me ask that, just because I know that, like we talked about, our audience is usually newer investors. So what kind of mailer? Like, what does it say? What does it look like?
Yeah. So we send out, different formats, right? I think the particular one that landed, I think it was like a handwritten letter, like a tri-folded handwritten letter with a handwritten envelope and a real stamp on it.
Gosh, we do a lot of direct mail, and there's very few lists that I think are important enough to do the handwritten route. But 100% of the time, I get, and I didn't realize this at the time, but when I first started sending out direct mail, I was sending to small multi-units between 5 and 10 units in Las Vegas. And my first mailer that I did something like 4,000 handwritten, hand addressed responses. And I had like a 5% response rate off of that at the time. That was the first one that I ever did. So I had no idea. Now, when we're sending out at scale, we're getting between a 0.5 and a 0.75 response rate. If I would have known back then what I know now, I could have bought all of those small apartments.
And it's a little bit different because, I mean, we're looking for really 30 plus units. Sure. And so it's a much smaller list, right? Versus if you're sending out for single family houses or something. So, we'll send out for, maybe like one we just did is like 50 plus units within Indianapolis,
sure.
And it's not thousands.
Are you targeting mom and pop owners, or you're targeting LLCs? It doesn't matter.
It doesn't matter. I mean, it's more about where they're at kind of in the cycle of ownership, sure. and and where the property is. And if there's anything that tells us, that they might be more probable to sell than others, like something like if a loan is coming up within, like if their loan is maturing within 2 years, because that's typically a time people will think about, should I sell? Should I refinance?
Sure. Yeah. That makes a lot of sense.
And so that's a good time to get in front of folks.
And so what does that content say that gets people calling?
Well, I can't give away all the secret sauce, but
you don't have to.
In general, I think that the handwritten thing honestly just goes a really long way. I think especially on the envelope, because, people sort mail over the trash can. Right. Mm-hmm. And nope. Oh, okay. Maybe I'll open this one. Right. And if I get a hand one, I mean, few and far between. So, let me see what this is. So at least you got to open it. Right. And then, I mean, we're not saying we don't have any crazy, hypnotic language or anything. It's really just, we're like little credibility about who we are, and our firm and what we're trying to do. And just showing that we're credible, and then saying that, we're interested in buying your apartment, and put the phone number on there. And that's kind of it. And, it's a small, I'll admit it's a small part of what we do right now. Sure. I mean, it is a focus for 2022 to really start growing that. Just as I'm seeing the inflation on prices on marketed properties, but yeah, it's just, we got, lucky on that one. The thing that I will tell people is it's just all about right place, right time. Sure. Because anybody that owns property knows that you get hundreds of those mailers. And so you may send 10, 12 to this guy, and that wasn't the right time, but maybe he just had a bad tenant experience, or maybe his sewer line just blew up or something. And he's like, you know what, I'm done with this thing. And he reads that mailer and he's like, all right, I'm out. It's right place, right time.
Sure. One of the things that you mentioned, though, was that you do a lot through commercial brokers. And I guess where I'm at is first, are you finding deals or are you creating deals? Because I think there's a huge difference. I've never found a deal off the MLS. I've never even seen a deal on the MLS. But what I have done is found properties on the MLS that we've found a way to turn into a deal. So like your value add stuff. And I'm wondering, being so competitive in the commercial market, are you guys paying top dollar for these deals? And then you're finding a value add opportunity that maybe other investors didn't see that makes it worth the price that you're paying? Or are you just this hard-nosed negotiator going in there and taking down these deals, beating out everybody else with less money, more time? What does that look like for you?
Well, no, the hard in today's market. I mean, we are in the seller of sellers market. Sure. So there's no hard-nosed negotiation to think that you're going to beat somebody down on price, because everything is selling 10% above ask. And 30 people are bidding on it. So, I mean, you got to understand, I think you have to approach your buying process in relation to where we're at in the cycle, right? And kind of who's holding the cards. And right now, sellers definitely are holding the cards. And so we pay top dollar. I mean, quote unquote top dollar. By top dollar, I'll say we will pay what they are asking for the property.
Sure.
If the numbers work, if I know that I can go in and I can still add value, meaning we can do renovations, we can add amenities, we can add other income items, and we can raise the net operating income in doing that and increase the value of the property, then I don't care what the purchase price is necessarily. Right. I mean, within reason. I also don't care. I don't know how familiar your audience is with cap rates, but cap rates are essentially like kind of how a market is valued. So, sure. So for example, like if you have a 5% cap rate market, that means that if whatever that income is, you're multiplying that income by 20 to get to what the value of the property is.
Sure.
So, 5 times 20 is 100. It's kind of how, if it's a 4 cap rate, then you multiply it by 25. So whatever that income is, for every dollar I can increase income, I can raise the value of the property $20 in a 5 cap market. And so, so I say that because I know I'm going to add value to the property. I don't even look very much at that going in cap rate. I may be buying it at a 4.5 going in cap rate based on what they've done historically, even though it's a 5% cap rate market, because I know that I can do more. And I know that by year 2, it'll be a 6 cap based on what I bought it for, income related to what I bought it for. Right. And so, so as long as the numbers work, do the deal.
Right. Yeah, absolutely. Now, as far as your role, obviously you're the CEO, but you have, I'm sure, partners and strategic team members that are helping you either analyze the deal, raise the money, find the property. Can you talk a little bit about what your team looks like and then what your role is inside the team on a tactical level?
Sure. Yeah. So I've got a team of 7, and it's made up of, underwriters or acquisition folks, the folks that are doing really the market research, the rent comps, the sales comps, the initial spreadsheet work, kind of getting everything into the spreadsheet so I can get in and just take a look at it and see if it makes sense, start to tweak things. But they're doing a lot of the heavy lifting on the front end. I've got an operations coordinator who really handles, she's kind of the hub inside, handles a lot of the internal pieces, HR, and also really acts as a transaction coordinator. So once we get it under contract to close, she's really the one that's making sure we're hitting all the deadlines and doing everything that we need to do. I've got a bookkeeper who keeps the books. She really handles all the accounting, which is super important and is often overlooked. And I think most people, that was one of those things I go back to common themes that don't make businesses not work is bad accounting. If you don't know what's coming in and what's going out and where it's going, you don't know anything. So, I mean, just pay money to get it right up front would be my advice, because it's like 5 times more expensive to fix it after you've done it wrong for a couple of years. So, but bookkeeper, and then I have a marketing person who kind of oversees the brand and everything that we're doing, and really social engagement and all those aspects. I have a video, like a videographer, and then he also edits my podcast. I have, a podcast booking person who's helping me get on great shows like this and booking people on my show. A whole just host of folks. And then outside of that, like that's my immediate team.
Sure.
And then you start to expand into the people I interact with daily, though, whether it's property managers, on different properties, whether it's my attorney who I pretty much talk with every day, other, like my insurance guy, like other really important people that are on the team that not directly employed by me.
Sure. They're the second circle, not that first circle.
Mm-hmm.
Gotcha. Okay. And so are you guys, you're managing all the managers, you are managing the team. Who's running, is your operations guy the one running the construction or the improvements and that kind of stuff on all of those teams or all those properties?
Yeah. So that's a good point. I actually didn't bring up. So we have, for several projects. We're going on this year that we decided to actually bring a maintenance guy on full time and to be able to handle the renovations and then a lot of the turns that we need to do. So it's kind of a blend. And then he has a team of a couple of guys focus on like the renovation work, like the stuff that we know we're going to do going into the property. And then the property manager and his team really manages maintenance requests.
Gotcha.
Like, hot water heater breaks, something like that. But we have a point person that's doing all that work, and he's doing it across, really he's focused on 2 properties right now, but he just moves from property to property as we acquire and have need.
And are you?
And the only other thing I'll say, for bigger stuff, we'll bring in a GC.
Right. Yeah, no, that makes sense. Are you guys are buying all over the country? Doesn't matter what market, or I mean, obviously it matters what market, but you're not local to just one area, right?
Well, we're really just focused on the Midwest.
Okay.
So we primarily today focus on Indiana, Ohio, Kentucky, Tennessee. We're starting to expand more into Kansas City and Missouri, but yeah, really focusing on the Midwest. I believe that I believe a lot of markets in the Sun Belt are overinflated. I think there's a lot of value to still be created in the Midwest. I think Midwest is starting to have its day, but it's still a little behind some of the others. And I really just looked at it from a strategic decision on, do I want to think I could fly all over the country and kind of build these deep broker relationships? Because that's what's critical to get deals. Or do I want to really focus on my backyard and where I know the market really well and I can build good relationships? And so really I thought about it as like a 3.5 hour radius around Indianapolis.
Gotcha.
And so we have properties right now in Indianapolis, Louisville, Kentucky, Lexington, Kentucky, and Dayton, Ohio.
Sure. And that makes sense. And now if you were smack dab in the middle of LA or San Francisco, it might not make sense. But if a good cash flow market also happens to be in your backyard, there's no reason to reinvent the wheel like that. Now, when you're running these syndications, are you working with the same group of people? Are you taking on new clients? Are all of them accredited investors? What is your funding portion of your syndication look like?
Yeah. So no, they all historically have not accredited investors. So it depends on the type of deal that we do. And it's probably too much in the weeds, but there's several SEC regulations and several types of deal structures that you can set up. Some allow you to bring in non-accredited investors. They still have to be sophisticated. That's a very gray area, but it basically means that they have to know enough to be able to evaluate the investment. And then others where you can only bring in accredited investors. So we've done both just based on the type of deal, the amount of money we needed to raise, and partners we had lined up. But yeah, I have a list of investors or current and potential investors. Folks will go to my website, they'll fill out an application, set up a call with me, and then from there they're able to get on the list. And what we do when we have a deal is we send out an email to the list with all the info. Then we'll host a webinar. We'll record the webinar. We'll send that out, and we ask people to do what's called a soft commitment. So at that point, you're not committing any capital, but you're essentially like raising your hand and saying, "Hey, I'm interested, and I'm interested for this amount." And that gets you in line. That's how I can track how much equity I'm raising, and that's how I can then know who to send out the legal paperwork to once the attorneys have all that back. And then at that point, you actually make your hard commitment. You'll fill out the paperwork. You'll send your money in, and then are you in the deal?
Sure. And are you at the point now where you're able to turn away difficult investors and you're able to really work with the type of people that you want? I think new investors get stuck in this. If somebody's willing to lend me money, let's do it. Or if somebody's willing to be my client, let's do it. But they don't consider the headache and time commitment that some people.
Yes.
cause.
No, 100%, man. And yeah, it's one of the best things about being an entrepreneur is you can choose who you work with. And, it is really hard when you're getting started to say, yeah, I'm going to turn down that person's $50,000 because, well, they're kind of a jerk, But those are some of the best decisions you'll ever make, honestly, especially if it's only 50K. If they're bringing like 100 or a million, like I can deal with a little more. But I mean, just honestly, there are just, look, you have to find people that you resonate with. Right. And I think the investors need that too, because it's a long-term relationship. This is like, I'm talking a 5-year relationship. Right. And we're going to be working together for 5 years. And so we have to like each other. We have to get along. We have to want to work together. We have to have communication styles that jive, right? Like if they're wanting me to communicate one way and that's not how I communicate, that's not going to work. That's one of the reasons why I force everybody to get on a Zoom call with me or meet in person if they're local before I actually would allow them to invest. Yeah. Even if they're accredited and they could just go into the deal, because there has to be that match. Sure. Yeah, that makes sense to me. And we've definitely had difficult clients and difficult lending partners. And, like you said, if it was $4 million, I might be able to put up with a little bit more. We've also found the lower the investment amount, the more difficult the clients tend to be, not because it's a lower investment amount, but typically the people who are investing those lower amounts, it's either their first time investing outside of the stock market or your 401k. And so they're more active or want to be more active in what should be a passive investment. How do you guys get around that kind of engagement? Well, I think that's absolutely true. Especially if it's folks' first investment, because there's a lot of uncertainty, right? Sure. I mean, there's a lot of fear when you're going into your first one. You're like, oh, I'm giving this guy so much money. Hope he actually returns something, right? So, I mean, I don't think there's any way getting around it. It's just part of the life cycle. I mean, I try to spend a lot of time educating our investors. I mean, I love working with investors where it's their first deal, because I really believe that by investing in real estate, you can change your life. You can build wealth. You can, whatever you want to do, you build a nest egg, you can retire early. Like you can do that through real estate. So I love getting people just on the train. Right. And then they start to get their distributions. They start to get those checks in the mail or right in their bank account. And then it really clicks for them. But yeah, I mean, you have to balance that. Right. I mean, I think that's why you have to understand what kind of person they are. And, if it's just because they want to understand, then like that's okay. If they're approaching it, in not such a nice way, then that's not okay. Sure. Yeah, that makes sense. Now, what I'm the last thing, and we'll start to wrap it up because we want to be respectful of your time. But on that deal that you just sold, how many of your investors are throwing their money back at you, asking for more? They want more of those 25% return type deals, I'm sure. Yeah, I mean that's 100%. I mean most investors I find want to keep investing over and over again. They don't want that money right now. They want to let it keep appreciating, right? Sure. And keep creating value. And so, yeah. And the best case scenario is when the timing works up. So I have a deal that they can get right into. Right. But yeah, I think that, I mean, absolutely. Especially if you're getting the 25% return, that's, year over year return. I mean, you can't get that anywhere else. No, I mean, not from a risk adjusted basis. You might hit a home run every once in a while with crypto or some angel investing or something, but you're going to lose out more times. Sure. Blackjack and roulette work sometimes too. Exactly. Yeah. It's the same thing, right? Real estate though, like I said, it's tried and true. It works for everybody if you do it right. It's one of those things that if you do it right, it works for everybody. And there's not that many examples of things like that. Yeah, absolutely. Well, Kent, it's been really good having you on. I think you do provide a lot of value. And where can our listeners go if they're interested in your podcast, or if they want to find more out about you? Where do you want to send them? Sure. So if you're interested in the podcast, it's Ritter on Real Estate. You can find it anywhere you listen to podcasts, and it's really focused on helping passive investors make better investing decisions. Sure. And so that's what we spend a lot of time on. If you want to check me out and get to know me more individually, you go to my website. It's kentritter.com. You can also get the podcast there. We have a weekly blog that we do. We have some like new investor guidance, terminology, FAQs, things like that to help people get in the game. And you can sign up to invest there as well.
Awesome, man. Well,
Fantastic.
we really appreciate your time today, and we look forward to talking to you again.
Yeah, I appreciate you guys. It was fun coming on. JD, Melissa, it was nice meeting you both, and
Thank you.
have a good rest of the day.
You too. Thanks, Kent.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter at The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.